What's up, everybody? Ryan Pulis here from the Pulis Group, bringing you your real estate tax tip. We are a tax and accounting firm specializing in tax planning for real estate investors. Today, I'm going to take you through Schedule E, which is a key part of your personal tax return, and it's where all of your real estate income and loss items show up. We'll take a look at a sample Schedule E so you can see how the numbers show up on the return. Schedule E, it's a 2-page schedule with 5 parts. The first part is where you report your income and losses from real estate that you own personally or through a disregarded entity such as a single member LLC. You'd report income here for both single family and multifamily homes, also commercial real estate, vacation homes, and short-term rentals that do not have substantial services provided. Those all show up here on part 1 of your Schedule E. The second page of Schedule E is used to report income and loss from K1 activity. So if you invest in syndicates or if you're a partner in a partnership, you'll receive a K1 each year reporting your income and loss items. The bottom page of Schedule E is a summary section that reports the total income and loss from all of your Schedule E activities. There's a special line for real estate professionals. On the 2020 form, it's line 43, which totals your income and loss for all activities that qualify for the real estate professional status. So now let's take a look at a sample Schedule E. So here is a sample Schedule E for Johnny Lawrence, who likes to invest in real estate when he's not teaching karate at Cobra Kai Studios. The first section here asks 2 different questions. You have question A, did you make any payments in 2020 that require you to file Form 1099? Generally, if you make payments during the year to unincorporated businesses or to individuals that exceed $600, you're required to file a Form 1099. In this example, we just answered no to keep it simple. Question B asks if you answered yes, will you file the required forms? Obviously, if you say yes to question A, you want to make sure you can say yes to question B and actually file those Form 1099s. Next, you'll see where you can list the physical address for each property. There's 3 row labels, A, B, and C, that are used to identify the property, and these carry throughout the form. So you can report up to 3 properties per Schedule E. If you need room for more than 3, you just attach an additional Schedule E. Underneath 1B, you'll see it's asking for property type, and this is it gives you 8 options. You'll see property type down here, 1, 2, 3, 4, 5, 6, 7, 8. 1 being single family, which is what we have here for Johnny's 3 properties. Under part 1, number 2, it's asking you to break out the number of fair rental days and personal use days for each property. Johnny rents his properties all year long, so he uses 365 days for the fair rental days and 0 days of personal use for all 3 properties. Next, you'll report the income and expense by property. Again, you have the A, B, and C columns to identify each property, which corresponds to the addresses above up in 1A. The income, the rental incomes reported on line 3, and the expenses follow on lines 5 to 19 with a total on line 20. So scroll down a little bit here and show you more of the form. Line 20 down here shows your total rental expenses by property. So you'll see here in column A, the total expenses are $18,682, and the income above from line 3 was $18,000. So we have a loss of $682 on line 21. And it looks like Johnny's showing losses for all 3 properties if you scan across on line 21. When line 21 is negative, you have to take into consideration the at-risk limitations. Generally, your at-risk limitations, your basis in the property, plus any debt you may be personally liable for, or debt that's secured by your real estate, which is referred to as qualified non-recourse financing. You cannot deduct losses for items that you're not at risk for. any properties. This is determined before taking into consideration the passive activity loss limitations, which come next on line 22. If all amounts are at risk, then you determine whether or not your losses are limited by the passive activity loss rules. Your at-risk limitations are reported on Form 6198, and the passive activity losses are reported on Form 8582. It's far more common to be limited by the passive activity loss rules than the at-risk limitations. Generally, real estate by default is a passive activity, which means losses are not allowed unless you have passive income to offset those losses. The losses can't be used to offset non-passive income such as W-2 wages or active business income unless you meet one of the exceptions. So there's two exceptions. One is you are a real estate professional. This is accomplished by spending greater than 50% of your time in real property trades or businesses in which you materially participate, and by spending more than 750 hours in real property trades or businesses in which you materially participate. So the greater than 50% of your time test means if you have a full-time W-2 job, you're likely not going to qualify as a real estate professional, but maybe your spouse can. The second exception is the active participation with modified adjusted gross income of less than $150,000. Active participation allows for a deduction up to $25,000 against non-passive income. The $25,000 deduction begins to phase out 50 cents for each dollar over $100,000 and is totally phased out at the $150,000 modified adjusted gross income limit. Next, on line 23, we report totals from various lines above. 23A reports total income from line 3 above. So you'll see our $69,000 here is the total of income from columns A, B, and C above. 18,000 plus 21,000 plus 30,000 gives us the 69,000. 23B reports total royalty income from line 4 above, which does not apply here. 23C is reporting the total mortgage interest from above on line 12. And 23D reports the total property's depreciation from line 18. And then we have 23E, which is the total of all expenses from line 20 for all properties in the aggregate. On line 24, you report the line 21 amounts for all properties that show income. In Johnny's case, that's zero because they're all showing a tax loss. On line 25, you show the losses. So here, in Johnny's case, we have a loss of $2,416, which is the total of his losses on the 3 properties from line 21. Now we'll move on to page 2. Oh, I'm sorry. Line 26 is the net of 25 and 24. So again, it's the $2,416 for Johnny. So on to page 2. Now here at the top of page 2, we have a question on line 27 that's asking us if we're reporting any suspended losses from a prior year or unreimbursed partnership expenses. Suspended losses from prior years are those that were disallowed due to basis limitations or at-risk limitations. The unreimbursed partnership expenses are just what they sound like. Those are expenses you've paid on behalf of the partnership that you've not been reimbursed for. You're allowed to reduce your partnership income by the amount of those unreimbursed partnership expenses. So if either case is true, you want to answer yes on line 27. Otherwise, choose no, which we did here. Johnny's checked the box no because neither applies to him. Income from partnerships and S corporations are provided to on K1s. So it looks like Johnny has 3 in this case. There's 2 partnerships and 1 S corporation. You can tell by looking at 28 column B, there's the P's and the S's, the P's being for partnership and S for S corporations. So Johnny has Just for Kicks and Body Bag Properties, which are partnerships, and Cobra Kai Studios is his S corporation. So just as in part 1, you see you've got the row labels A, B, C, and in this case D, that identify each entity and will carry through down below, where you can see you can kind of tie back the income or loss for each entity above. And again, if you need more room, if you have more than 4 entities to report here, you just attach an additional Schedule E. Line 28, columns G through K are where you report the items of income, loss, or deduction. There's a column for passive losses and then passive income in column H. Non-passive losses are in column I, and column J is for your section 179 expense deduction. And finally, over on the far right, you have column K, non-passive income. So looks like Johnny has a $25,000 passive loss that's allowed in column G from Just for Kicks, and $30,000 in passive income from Body Bag Properties in column H. His karate studio is showing a $50,000 non-passive income item from the S corporation over here in column K. Now on line 30, you're just going to total the income items, both passive and non-passive. So in this example, we have $80,000, which is the total of the $50,000 from the S corporation and the $30,000 from the Body Bag Properties. Line 31 is a total of your loss in section 179 items. So in Johnny's case, we have the passive loss from column G showing up as a minus $25,000 on line 31. And 32 is just your total. You net lines 30 and 31. Now we'll take a look at part 3, which there's no information on here, but part 3 is basically the same thing as part 2, but you're reporting income and loss from estates and trusts that come to you on a K1. So the setup's very similar. You have the name and EIN above, and on line 33, columns A and B. Down below on columns B through F, you show your income items and loss items broken out by passive and non-passive. And line 35 is just your total income items from the trusts and estates. Line 36 is a total of the loss items. And then 37 would be a net of those two. So we don't have any numbers on here to look at, but it works just the same as part 2. Now, part 4 is where you report income or loss items from REMIC, which stands for Real Estate Mortgage Investment Conduit. You don't see very many of these. If you do invest in a REMIC, you'll receive a Schedule Q each quarter that reports your quarterly share of income and loss. Down at the bottom in part 5 is the summary section. This section reports the totals of the above parts 1 through 4 of Schedule E, all of your income and loss activities. So in Johnny's case, on line 41, we're showing $52,584 of income, which is the total from line 32 above, the $55,000. And the losses from part 1 through rental properties of $2,416. So that's where we're coming up with the $52,584. Now down here, Johnny's not a real estate professional because he works full-time in his karate studio. The reconciliation for real estate professionals is where you would show your total income and loss for activities for which you qualify as a real estate professional. And that about sums it up for Schedule E. Hopefully this was helpful. If you like what you saw, go ahead and leave us a like and a comment below. And you can visit us on our website at thepulicegroup.com. That's ThePulicegroup.com. We're taking new clients, so you can hit us up on our contact page. Thanks a lot.